Mills is down 25% year to date, trading right there at its 52-week low, offering a forward yield of just below 4%. But is it a buy now? Let's take a look. We're going to look at the historical performance of GIS. We're going to jump into their income statement, looking at their top line revenue as well as their bottom line net income growth. We want to have a look at the health check of their company, their total cash versus total debt after their latest earnings. And we will analyze on a total return basis year to date how they have performed versus some of their competitors in the same industry. As always, we will take a look at that all-important dividend safety and some very important financial metrics you need to understand before investing, and we'll also take a quick sneak peek at what the institutions are doing, whether they are buying or selling this company, and as always, we will run them through our stock valuation model, getting to our intrinsic value and acceptable buy price given that investor margin of safety. Now, taking a look, it is down 25% year to date. Investors who have been holding this company over the last 10 years would have been on a pretty rocky road, up 23% now, although it doesn't include those dividends reinvested. And we do see it hit its all-time high over the last 10 years at around $90, $91 towards the beginning of the year. So is there a lot of room for GIS to grow? Can we expect to see that share price double or triple over the next few years and get that yield on cost heading more towards double digits, 10, 11%? Let's jump straight into the income statement. Now, they have reported their latest quarterly earnings. So let's take a look. Now, typically on the top line, we like to see 3 to 7% growth year on year. It has gone from around 17 billion in 2019 to around 20 billion in May 2023. So over the last 5 years, it has increased, not very rapidly, but we will look at the last 10 years percentage-wise shortly. Now, on a more granular level, we do see an increase every single year, so that is positive to note. The top line is increasing, but when we analyze, we'll see whether or not they're at least keeping up with that 4% inflation. Now, what story does the bottom line tell us? Well, 1.7 billion of net income in 2019, 2.6 billion in 2023. So very nice to see the bottom line has also increased in line with that revenue increase. However, on a more granular level, whilst we do see an increase to 2022, it did then take a very small drop in 2023. So slight inconsistencies on the top line and bottom line, but overall it has grown from that 5-year position. Now, quick health check, total cash versus total debt, 450 million of cash in short-term investments in 2019. Latest quarterly report sitting around 491, so they're holding a little bit more cash than they did 5 years ago. And now when we take a look at their total debt to see how that has changed numerically and directionally, we see it has gone from 14.5 billion to around 12.3. So it is positive to see their cash has increased very slightly, but it is good to see their total debt has in fact come down by more than 10%, so that is a very good sign. Now we'll look at the net debt to EBITDA metric as well to see how that dividend is looking to be safe. Now, companies in a similar industry, the packaged food and meats, we have the Hershey Company, Kraft Heinz, and a few other well-known. Now, year to date, remember, it does include those dividends reinvested. They are, in fact, the worst performing, down 22.5%, although we do see the majority of the industry has had negative returns this year. When we expand that to the last 5 years, GIS is up around 75%, and in fact it is the second best performer from our comparative data, with Hershey there at number 1. So yes, past performance is never indicative of the future, but 75% over the last 5 years is certainly not bad from any return on investment. Now, very quickly, institutional ownership sitting at 75%, with around 4.8 billion worth of sales from these institutions over the last 12 months, and marginally larger buys in the same period. So overall, institutions are buying slightly more than they are selling, although interestingly, over the last 3 quarters, in fact in all of 2023, institutions have sold more shares of GIS than they have bought, as we can see. And if we go back one more quarter, we do see a very large buy as opposed to a sell. So always take that with a pinch of salt, always do your own due diligence, and never again copy what institutions do. Now, before we take a look at the dividend safety, we can jump very quickly into their earnings. Latest earnings report from August 2023, they in fact beat very slightly the earnings per share and a very minimal beat on the top line revenue. When we take a look at the previous quarter, we do in fact see a beat on the earnings per share, a drop on that essential miss to the top line revenue, and then the 2 preceding quarters we do see them beat. So overall they have performed very well in comparison to analyst estimates, But if we look at Q3 23 versus Q3 22, we see they did beat on the top line by around 4%. However, the remaining metrics don't look overall great. They did, unfortunately, get lower net income than they did last year for the same quarter. Earnings per share was less, as well as the net profit margin, although the operating margin was slightly higher. So some benefits there. They have been being a Wall Street analyst, but they have not really beat on that bottom line over the last quarter. And that last quarter increase is roughly in line with inflation for the top line. Now, the dividend is very safe. We see a score of 90, making it very safe with a market cap of 36 billion. It is a large cap company. Now, in terms of recessionary metrics, for those that see a recession right around the corner in 2024, they did in fact increase the dividend during the 07-09 recession. Relatively flat sales, but remember it was above the average growth of companies in the S&P 500, which was just negative. And we see a very, very strong, one of the best recession returns. So we do see a negative 12%, which is much better than the negative 55 of the S&P. And this is one of the best recession returns we have analyzed on the channel. Yes, it is negative, but given the whole market of the S&P went down 55, that is a very decent return. Now, latest increase, they did increase 9.3% in June 23. We love to see that, well above the minimum 4% I advocate to beat inflation. 2% over the last 5 years, not the greatest, and 20% over the last 20 years, 7%, which is fairly positive. But if we do look at the more recent data, they have been struggling with that dividend increase, and we can see some years where they in fact didn't change that dividend. So they have only been paying increasing dividends for the last 3 years, but a phenomenal point here, they have been paying dividends without a reduction over the last 125 years. Now, dividend yield theory, as always, states a company is undervalued when the current yield sits above the 5-year average. So we do have our first sign of undervaluation, 3.77 versus 3.32. Do bear in mind, though, we're not looking at any of these models in isolation, and we'll draw our conclusions towards the end of the episode. We then have the forward PE, 13.8, lower than the 5-year average, another sign of undervaluation. And our third and final sign with the General Mills PE, much lower than the consumer staples at 18.7. Now, yes, it is at the 52-week low, but do bear in mind 52-week low is never a signal for undervaluation. Free cash flow, always focus on that. Do ignore the earnings, or I do personally, because it is susceptible to manipulation by management through accounting, and we run through a ton of examples on the channel and point out exactly why that is. Free cash flow, I personally like below 60%. You could increase that for the consumer staples industry to 70%. But over the whole period, we do see it pretty much below 60% continuously. 61 in 2023. It is expected to come down in 2024, which is positive to see. The lower the percentage, in my opinion, around that 60% or lower, does give me faith that management have the ability to increase to around those double digits we love to see. Free cash flow per share, $2.99 in 2014, $3.51 in 2023. It has increased, but it isn't a very rapidly increasing company in terms of their free cash flow. So do bear that in mind, but it is positive to see it is moving towards the upward trajectory. Sales growth, now 3 to 7% is really a minimum. 3 to 4% is really just keeping in line with inflation. 2014 to 2018 wasn't a particularly great time for the company. We see the top line, in fact, decrease over that 5-year period. But after then, we do see around that 3 to 7% that we do look for. So again, that is better. But ideally, we would like to see it be more consistent over the longer term. So numerically, what does this translate to? Well, 17.9 billion of sales in 2014, 20.1 in 2023. Now, they do share buybacks, which is positive, returning excess cash to companies' pockets, or in fact, excess cash to investor pockets. But they've also issued shares such as 2018 to 2019 to dilute shareholder ownership. So over the whole 10 years, they have bought back around 36, in fact 45 million shares from 646 to 601. Now ROIC, remember it is one of my 7 golden dividend metrics. 10% or more, it gives me faith that management are able to effectively allocate their capital. And we can see it's consistently above that with the last few years in the mid-teens. So very strong to see and gives me faith personally in management and their ability. Operating margin, now this is one that it's in fact consumer staples do struggle with quite a lot. If you've seen the channel, a lot of them don't hit that 16%. So it's nice to see that GIS have managed to hit that every single year consecutively. And on the free cash flow margin, no real worries here, well above that 7% that we do look for in the industry. Now, the net debt to EBITDA is one of those that does correlate to the dividend safety. It effectively tells us the number of years it would take the company to pay off all of their debt net of cash on hand. And it has come down from that 2018 peak to below 3, in fact, at 2.8. and 2.73 is expected in 2024. So that is positive to see that they do have a very strong balance sheet. As we analyse, they are in fact holding more cash over the last 5 years and have paid off more than 10% of their debt. So lots of positive signs for General Mills, which does sit towards the effective 52-week low. Now we'll jump into the stock valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit the subscribe and bell so you are continually notified of these videos as they drop. And if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list, do click on that pinned comment. Jumping into the first model, we have GIS. We have the earnings per share at 4.1. Growth rate per analyst estimates, and that current yield on AAA corporate bonds. Remember, the lower the yield, the higher the intrinsic value, and it's been the first time in a while that we've seen it come below 5. So intrinsic value coming to essentially $58.31. When we take a look, that is roughly a few dollars shy of the current trading price and a few dollars shy of that 52-week low. So there are some signs of reasonable valuation / maybe overvaluation, you could argue. But remember, we don't look at any model in isolation and we'll draw our conclusions towards the end of the episode. We then have companies in a similar sector and size that we analyse: Kellanova, Hershey's, Kraft Heinz, Campbell Soup. Stock price, earnings per share, PE multiple, average PE multiplied by the earnings per share to give a stock price of $72. Now when we take a look, that is some nice upside to the current trading price, but it's still within that 52-week range, showing signs of undervaluation in the current market. We then move on to the third model, the DDM, dividend discount model, where we have our yearly dividends. We have the growth rate, average growth rate, just under 4% of the last 5 years. Forward looking, we are aiming for around 5% based on the last few years with the nice increases. You could be more optimistic, maybe more pessimistic and argue a different percentage. But if you grab a copy of the model, you can play around with the percentages to get your DDM price. Based on my estimates, we're getting to 82.60. Nice upside again to the current trading price, but still lower than that 52-week high, showing some signs here of undervaluation. We then move on to the fourth and final model, the DCF model, discounted cash flow, where we have our free cash flows year on year. Average growth, forward looking in line roughly with that average. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to give a DCF price of $78. Now again, nice upside to the current trading price, but still below that 52-week high, showing signs again of some undervaluation in the current market. Now remember, the intrinsic value is just the average of the models we have just gone through. And as always, if you do enjoy the content, values being provided, smash the like button, hit the subscribe and bell so you are continually notified of these videos as they drop. Now the margin of safety, as always, we start off with 10%. If we believe it has a wide moat, strong financial metrics, good forward-looking data. So right now you are getting a 10% margin of safety up to $65.61. If you move that to 15%, you would be looking, I would say, roughly a few cents shy of the current trading price. So you are right now getting a 15% margin of safety if you were to buy GIS based on our estimates up to around $62. Now for those who are looking for a much larger margin of safety, 20%, it would be around $58. And we can see that is a few dollars shy of the 52-week low. So right now, although you are getting a 15% margin of safety, personally, I would be waiting for at least 20% for this company. Now, in terms of Wall Street, well, they believe the share price to go up by around $10, roughly in line with our intrinsic value. So they do believe there to be some nice upside to General Mills currently. As always, let me know your thoughts. Is General Mills one that you're looking to add to? Is it one you've already bought? Or if you're looking to avoid it, is there any particular reason? As always, if you want to grab a copy of the valuation model to get to your intrinsic value or acceptable buy price of companies, whether it's in your own portfolio, companies on your watch list that you're looking for a target price, then do click on that pinned comment below. Finally, if you enjoy the content, values being provided, smash the like button. It helps this video get pushed out to other similar investors, helps us grow our community. And if you do want to know when these videos do drop, hit that bell button so you get these delivered directly to your doorstep. As always, have a great day, catch you on the next episode and take care.